Hello everyone! Today, we're diving into a comprehensive guide for building wealth and achieving a comfortable retirement by age 55. This plan is tailored for someone currently in their 30s, giving us a 15-year horizon to reach our financial goals. First, let's establish our retirement assumptions. Our goal is to retire comfortably at age 55. What does comfortable mean? It means maintaining a similar, if not enhanced, lifestyle to what you enjoy today, free from financial stress. Let's estimate annual expenses at retirement. A good starting point is to assume your current annual expenses, adjusted for inflation, potentially reduced for work-related costs like commuting, but increased for leisure activities like travel. For this plan, let's assume an estimated annual expense of $80,000 in today's dollars. To calculate our target retirement portfolio value, we need to consider inflation and a safe withdrawal rate. We'll use a conservative inflation assumption of 3% per year and a conservative portfolio return assumption of 6% per year. During the accumulation phase, for retirement, we'll target a safe withdrawal rate of 4%. With these figures, our target retirement portfolio value would be approximately $2 million in today's dollars. To support $80,000 in annual expenses, this number will need to be adjusted for inflation by the time you retire. Now let's outline the wealth building strategy to reach our target of $2 million in 15 years. Assuming a 6% annual return, we would need to invest approximately $5,500 per month, or $66,000 annually. This translates to a significant savings rate. If your current annual income is $100,000, this would be a 66% savings rate. This highlights the importance of increasing income and managing expenses. Let's look at growth milestones. Year 5, target portfolio value of approximately $390,000. Year 10, target portfolio value of approximately $950,000. Year 15, retirement at 55, target portfolio value of approximately $2,000. Given a moderate aggressive risk profile in your 30s, gradually becoming conservative near retirement, here's a suggested asset allocation. Initial allocation, age 30s, broad market ETFs, 40%, growth ETFs, stocks, 30%, e.g., VOO, SPY, VT, dividend, income assets, 15%, e.g., VYM, SCHD, REITs, bonds or defensive assets, 10%, e.g., BND, TLT, cash or cash equivalents, 5%, for emergencies and opportunities. This portfolio is US focused, but globally diversified through broad market ETFs, like VT, which includes international stocks. Rebalance your portfolio annually or semi-annually. This involves selling assets that have performed well and buying those that have underperformed to bring your portfolio back to its target allocation. This helps manage risk and ensures you're not overexposed to any single asset class. As you approach age 55, your risk profile should gradually shift to conservative. Age 45, 10 years to retirement. Broad market ETFs, 35%. Growth ETFs, stocks, 20%. Dividend, income assets, 20%. Bonds or defensive assets, 20%. Cash or cash equivalents, 5%. Age 50, 5 years to retirement. Broad market ETFs, 25%. Growth ETFs, stocks, 10%. Dividend income assets, 25%. Bonds or defensive assets, 30%. Cash or cash equivalents, 10%. Market crashes are inevitable. Your strategy should be to stay invested, avoid panic selling, dollar cost averaging, DCA, continue investing a fixed amount regularly, buying more shares when prices are low, rebalance, use market downturns as opportunities to buy undervalued assets. Emergency fund. Maintain a robust emergency fund, 6 to 12 months of expenses. to avoid selling investments during downturns. Dividend reinvestment, DRIP, automatically reinvests dividends to buy more shares, leveraging compounding, covered calls, conservative options. For experienced investors, selling covered calls on a portion of your stock holdings can generate additional income, but this requires careful management and understanding of options. Dollar cost averaging, DCA, versus lump sum. DCA is generally recommended for most investors to mitigate risk, especially when starting with a large sum. Lump sum investing can sometimes outperform, but it carries higher timing risk. Upon retirement at 55, your portfolio will transition from accumulation to distribution. The 4% rule is a common guideline, suggesting you can withdraw 4% of your initial portfolio value each year, adjusted for inflation, with a high probability of your money lasting 30 years or more. For a $2 million portfolio, this means an initial annual withdrawal of $80,000, generating passive income. After retirement, dividend stocks, chart ETFs, continue holding income-generating assets. Bond laddering. Create a bond ladder to provide predictable income streams. Real estate, REITs, or rental property. If you have real estate exposure, it can provide rental income. Annuities. Consider a portion of your portfolio in annuities for guaranteed income, though they come with trade-offs. Longevity planning. To ensure your portfolio lasts, regularly review your spending, investment performance, and inflation. Be flexible with your withdrawal rate if market conditions are unfavorable. A diversified portfolio with a mix of growth and income assets, along with a conservative withdrawal strategy, enhances longevity. This table illustrates the power of consistent investing and compounding. Remember, these are illustrative figures, and actual returns may vary. This plan provides a solid framework. Remember to regularly review and adjust your plan based on your personal circumstances, market conditions, and financial goals. Happy investing!